And let's talk Palantir also, because that's giving investors something to cheer about. The software company forecasts 2026 revenue well above Wall Street expectations, projecting a 61% jump in revenue to about $7.2 billion for the full year. Here to give us his takeaways from the results, Yahoo Finance tech editor Dan Howley. So Dan, it's very interesting at Palantir because for a while it was mostly reliant on government revenue, and the line was that it needed to get more commercial. Seems to have done that.
Yeah, they really have. I said 61% revenue growth projected for 2026. That's year over year versus 2025. But for this quarter, they saw U.S. revenue grow 93% year over year. Commercial revenue was up 137% year over year to about $507 million. And then obviously government revenue was up as well, 66% year over year to $570 million. They also said that they saw revenue grow for this particular quarter 70% year over year to 1.41, give or take, billion dollars. So obviously a very good quarter for Palantir. And it came after, the stock had a big sell-off towards the end of 2025, early 2026, basically since their last earnings report. All around the fear of an AI bubble, whether this is going to succeed. Michael Berry obviously had a note out saying that he had bearish sentiment on it, well, more than bearish sentiment on the company, and that really the big X factor for it, the kind of forward deployed engineers weren't really a long-term kind of sustainable growth pattern for them. But clearly they performed this quarter, and they believe that they're going to continue to perform going forward.
And Alex Karp, of course, always very outspoken on these conference calls. What did he say? It was cosmic something?
The results were like a cosmic reward for investors or something along those lines. Yeah. He likes to pontificate in his notes and his public appearances, and obviously in his kind of reaction here to the numbers. I think one of the big things out of Davos was him basically saying, yeah, I don't know if I necessarily should be doing this, but I'm doing it. Going out and talking. He says that employees tell him to stop doing that as much, kind of maybe fade into the background and not be as active out there. He had a kind of big to do at the New York Times Deal Book Summit late last year as well, when he was on stage. So yeah, he likes to make these kind of grandiose statements, but clearly they're backing it up from these results now.
They are. I will say just quickly, I know there's been some internal talk about the company's contract with ICE, especially over the past month or so. Did he talk about that at all?
Yeah, I mean, that's something that has been just an ongoing issue for them. Whether or not their technology should be used by ICE as its own organization. He's backed that up in the past, basically saying that they work with the government. They try to ensure that there's no misuse or anything along those lines. But this has absolutely been something that has come under fire a lot more now, even though it was previously under fire for being used by ICE. So, I think they're going to continue that moving forward.
We've talked about Palantir before. I know it's the valuation conundrum with this one, Gil. But the higher that its profit gets, the marginally better that valuation looks, right?
That's right. They were growing into their valuation even at 50% growth, and then they went to 60% growth, and now they're growing 70%. So they're going to grow into that valuation a lot faster than we thought. That doesn't mean that curmudgeonly old software analysts like us are going to be stuck in our ways and hard to recommend a stock trading at 60 times revenue. But the investors that have bought Palantir over the last couple of years sure are happy right now.
What do you think? How do you think about Palantir's business prospects? I mean, you listen to Alex Karp and you get a very optimistic view of what the growth is going to look like for the foreseeable future for this company. Where do you think sort of the biggest opportunities are still untapped for Palantir?
Well, opportunities abound. Right now, the main opportunity is in the U.S. commercial business. That's the business they just grew 137%. And the reason is very simple. They're going to companies and they're telling the CEO, what's your biggest problem? We can solve it with AI. and CEOs are taking them up on it. These are very big contracts they're signing Palantir to, and Palantir is delivering, which makes selling to other CEOs very easy right now. So that's their biggest opportunity. It's not that they're not growing in US government 66% or growing internationally. They're growing internationally as well. But US commercial, you have so many companies that have spent 3 years trying to figure out how can AI solve my problems. And nobody's been able to do that for them except for Palantir. And it's what Palantir has been building over 20 years is paying off now. Their abilities to take companies' data and organize it well, they call that ontology. Their ability to deploy that with their own people, they call them forward deployed engineers. These are very unique capabilities they've developed over a long period of time. And in the era of AI, that's paying off. And they're able to do something that no other software company can do. That's why they're so successful, and doesn't look like it's going to slow down anytime soon.
Well, and you hit upon something that I really wanted to ask you about, which is sort of Palantir versus everybody else within software. As you well know, most software stocks have had a very rough go of it for really the past at least 6 months, if not longer. Palantir started to get rough towards the end of that period, but it really hasn't traded like its cohort. And do you think that that is justified? Do you think software broadly is going to continue to muddle along even as Palantir continues to grow?
We actually think that software companies are overly maligned right now. They do provide very valuable services to their customers. They're still very good businesses, growing fast with good margins that can scale well and are hard to switch out of. The software business is still good. We understand concerns about AI. We're in a period of uncertainty. But the answer that includes Palantir is good software companies will execute well as this technology disruption happens and will win. Bad software companies will falter. This is like 30 years ago when we started buying things online. Best Buy and Circuit City were in the same boat. And here we are today. Best Buy is a big, thriving business, and Circuit City's been bankrupt for 25 years. Good software companies will succeed in the era of AI, and there's no better software company than Palantir.
So I guess to oversimplify it, what separates a good software company from a bad software company? Is it just what you talked about earlier, that Palantir comes to a company and says, we can solve your problem, and they actually solve it? And maybe not everyone is doing that to the same degree right now.
That's right. So a good software company is the company that's market leader, that helps their customers solve problems, and importantly, helps their customers adopt a new solution. So I'll give you a couple of examples that are top of our list right now. Snowflake and Datadog. Snowflake's the leader in data warehouse, data lake type services. You can't do AI unless your data is all in one place. That's Snowflake. Datadog, the leader in observability of applications and infrastructure. You can't deploy AI solutions without keeping an eye on them. It's the leader, and therefore it's also serving the AI natives like OpenAI and Anthropic, et cetera. Companies like that have evolved and are going to continue to evolve well with AI will win. And in fact, they'll win even more than before AI. And so not all software companies are created equal. There are software companies that will fall by the wayside, just like any technology wave. Software life cycles are very short. You either succeed wildly or you get bought by private equity. There's really very few companies that have just been around for a long time. And so the good companies will do well, but there will be victims just like any other technology disruption.
Gil, while I have you, I do want to ask you about a couple of companies that report still this week. That's Amazon and Alphabet. Speaking of companies whose fortunes have diverged over the past year, you can look at these stock prices. Alphabet's up something like 70%, and Amazon hasn't done much of anything. Does that mean the bar is lower for Amazon, or does it still have a lot to prove here to investors?
Yeah, the bar is lower. No, good news for Amazon. The fourth quarter was good for the consumer. And in their retail business, they've been able to adapt well to tariffs and other challenges. So the retail business should do well. Margins should be strong because of how much automation and how much they've invested in their logistics and shipping to reduce costs there. And then on the AWS side, they're growing slower than Google Cloud and Azure, but they do have an opportunity to accelerate as they deploy more compute for Anthropic. So yes, there's been the laggard, but there's reason to think that if they do better, they'll get more credit for the fact that AWS is still the biggest hyperscaler. It's substantially bigger than Azure and even bigger lead over Google Cloud. So they still have the opportunity to grow in this market, and Anthropic should be helping them right now as they deploy more compute capacity for them.
And Gil, what does Alphabet need to say to keep the party going?
Yeah, so Alphabet's in good shape in the sense that Microsoft Azure's success probably means that Google Cloud is accelerated as well. Meta's success in selling ads probably means that Google advertising businesses around search, YouTube, etc. should accelerate. So they're in good shape. Expectations are very high. The multiple in the high 20s is about 10 points higher than it was just 3 or 4 months ago. So expectations are high for Google to win and dominate AI. That may be a little ambitious, but this quarter should be good because their two most important businesses should either stay at nice levels of growth or maybe even accelerate.
Gil, great to see you as always. Thanks so much.
Thank you.
Tom, are you a buyer or seller on Palantir? Giant quarter. I still think the stock is misunderstood because nobody's reading the financial statements.
Misunderstood in what way? Well, let me say
No,
this.
they just think it's hype, Tom. They just think, Palantir, it's hype. There's no fundamentals behind it. This company's crushing it.
Look, the fundamentals are the fundamentals. Their revenues are up 70% year on year. Their adjusted EPS is up 79%. Their guidance, they're guiding for 7.2 billion in revenues in 2026, which will be up 61%. So all that is great news, but price is what you pay, value is what you get. So if all that stuff happens, you're still paying 100 times free cash flow. You're still paying 158 times forward multiple. And you could say, okay, this time's different. It's going to continue to grow, and therefore the super high multiple is justified. And I would say maybe that's true. But if they miss by 1 or 2%, the stock, doesn't go down 10%. It goes down, like silver went down on Friday, chasing shiny objects. Look, I hope it absolutely works for them. But at these valuations, you have very little margin of safety. And there was a great company like this about 25 years ago. The name was called Amazon.com in 2000, and they promised all these crazy things. We're going to be the store of everything. We're going to deliver to your house. We're going to get into the computer business, blah, 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 blah. They did all of that and more beyond what they promised in 2000. The problem was in the interim, you had this little 90% drawdown because you were already paying for 30 years of great execution all up front in 2000, and it corrected. They delivered everything they said they were going to do, and 15 years later, the stock was at new all-time highs. So, you could have a situation like that, or you could have a tree that grows to the sky and it continues to deliver and it continues to command the high valuation. And that's something you have at these type of multiples. You gotta know that you're making that bet. And if you're making that bet, just know what you're in and why you're doing it. And it's a momentum trade, not a mathematical trade.
So we were just talking about Palantir, which seems to be almost its own entity within the AI universe. We've got Amazon and Alphabet coming out later this week. But it feels as though after the huge surge last year in spending plans, enthusiasm, that we've entered a different phase in the AI trade. How are you thinking about it now?
I think that's fair, because if you look at the last 6 months or so, tech was going sideways. It didn't go anywhere, but there is a huge dispersion underneath the surface. You look at during the same period, the gap between software as a service and semis, it's 60% in performance, the difference between the two. So there is definitely greater differentiation within the AI ecosystem. But more broadly, I would say though, earnings are still quite strong, and because price hasn't gone anywhere, in terms of valuation attractiveness, it has become more attractive, but we just need to be more selective. So, thinking about the infrastructure layer that we favor, look at the likes of the hardware, compute, and chips as kind of the selective sub-themes that we like within AI versus software, perhaps a bit less in favor because it's being disrupted a little bit more. But the bigger picture is that, like we in our global outlook talk about how we need to see new revenues being generated to support the significant capex spending commitment that these companies put out there. So it's not just about kind of taking a greater share of the same pie. The pie needs to grow. So over the medium term, we need to see companies, hyperscalers, actually kind of thinking vertically, applying AI to other sectors, pharmaceuticals or financial services.
And when you're looking at the tech plays, the various subsectors, so you must be scrutinizing the growth trajectory, but also I'm curious how closely you're looking at balance sheets, if that has changed, or if you think that's something investors really need to focus on, given the enormous spending needs.
That's right. Actually, to your point about this is a slightly different phase in AI, it can be said about kind of the evolution of balance sheet as well, because up until now, a lot of these companies were able to fund their spending from their huge pile of cash, free cash flow. And it has been somewhat really kind of easily kind of taken by markets. But because we're at this point where spending is still happening and we're talking about similar level of capex for this year compared to last year, but revenue will take some time to come through, and the time gap between the spending and revenue creation means that we're going to need to see more leverage, which is why companies are going into the credit market to issue debt to fund their capex commitment. And this is a bit different because markets then start to scrutinize a little bit more and say, okay, what is your starting point? Can you afford to issue that? If you cannot afford to issue that, maybe you issue equity, which is what we saw in Oracle recently, right? So I think greater scrutiny around the health of the balance sheet is indeed a characteristic of this phase of AI. But the good news is that compared with the 2000, the starting point of these companies are so much healthier. They are issuing that from position of net cash rather than position of net debt. So it will be a while yet before we look at the balance sheet in aggregate and say this is very worrisome.
Gotcha. The other thing I wanted to ask you about is we tend to speak a lot about the AI trade in the US, but you're a global strategist. And at the same time, we see this trend of more interest in international markets that really started to rise last year, but seems to be persisting. So how do you think investors should put those two things together? Think about the AI trade, but not exclusively in the US.
I think there is definitely diffusion and diversification to be considered from an AI implementation perspective. Last year, South Korea equity market almost doubled, and it's because, number one, valuation, but number two, also because of the concentration of the AI play in its equity market. You look at Chinese equity market last year with the DeepSeek news, that has certainly also helped to kind of support sentiment towards the market. So AI is definitely a global theme, concentrated in the US, but as we think about kind of not just the build out, but also the application layer, this is where international market looks a little bit more interesting compared to before. Even in Europe, I'm based in London, I speak to investors and clients all across Europe and globally as well. In Europe, people complain about, okay, it doesn't have a lot of exposure to AI, is it going to be left behind? But actually sectors, traditional sectors like financial services and healthcare, they are ripe for disruption, and investors are looking forward to kind of thinking about what AI can do to those particularly thought of as traditional sectors in Europe. So globally, there are sectors that can really benefit from application of AI. We're seeing productivity boost coming through on a sector basis, and I think that will drive the next phase of earnings growth.
And you think even in a market like the Kospi, like South Korea, where we've seen all that upside, that there could potentially be more upside from this trend?
Well, if you look at the relative performance of emerging market over developed market, you look at that ratio, yes, it's rallied last year. It rebounded and outperformed developed markets last year, but we're starting from a multi-year, almost a decade of underperformance, right? So here, it's also closely tied to the dollar. If the dollar stays at the current level, maybe even weaken a little bit, that gives the incentive for capitals to perhaps go outside of the US to seek international opportunities. But here I would say really be selective rather than across the board, because at times of transformation driven by AI, it's not a rising tide lifting all boat. It's creating winners, but it's also creating losers. So really thinking about being very selective, which layer of AI do we want to have exposure to.
I also wanted to ask how rates fit into this picture. I mean, that goes back to the balance sheet. It speaks to the willingness to spend of some of these guys. Do you think we're getting 3 cuts here in the U.S. this year, or what's your outlook now that we know Kevin Warsh is going to be in charge of the Fed?
Well, markets are looking at 2, and it's not starting until second half of the year. We think that sounds about right. I would say that like people look at Kevin Walsh and say, is he dovish? Is he hawkish? We actually think that framing is misplaced. Is missing the bigger picture, which is actually how is he going to manage pressure to cut rate in the context of the broader economy and in the context of the broader environment. Here, the good news is that actually labor market is softer than the actual economy. This week we're not going to have the NFP because of the partial shutdown of the government, but the big picture is that we have been in this no firing, no hiring stasis in the US labor market for a while, and one of the Fed's mandate is maximum employment. So if the labor market is somewhat soft compared to before, it gives them the macro cover to cut rate without it being like a huge political debate. And here the combination of actually the economy seemingly stronger than the labor market. You look at yesterday's ISM data, which is stronger than almost all the economists' forecasts. The combination of a strong economy and a slightly softer labor market, and what this means for the Fed, given its maximum employment mandate, together with inflation, of course, actually paints a picture of risk-on environment for assets, because the stronger growth supports earnings, and the rate environment, it's going to be manageable, even though term premiums should go higher, and equities are in a good position in this environment.